Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Knecht, president of Universal Accounting Center, and this is a show dedicated to helping individuals who own and operate businesses, bookkeeping, accounting, and tax businesses with the intent of giving you the tools, resources, and support you need to offer basically quality accounting services and getting paid what you're worth. It's the intent of actually helping you address things ranging from marketing, selling, pricing, staff training, client relationships, mental health, exit strategies, all those things that are relevant to you as you're running your business to, in fact, build the premier accounting firm in your area. It's here on the show each and every week that we have on guests, experts in their own right as to what it is that we should be doing as we consider things related to our business. And today's going to be an excellent example of that. This is someone that I've been excited to meet and discuss with on the show because I've known him for some time. It's Gary Shamis. Gary happens to be someone that is very experienced. He assumed the responsibilities of his father's accounting firm in 1981. And over the 35 years that followed, he took the revenues from $225,000 up to approaching $100 million, with employees from a dozen to 600. He built the 37th largest independent accounting and consulting firm in the nation before combining SS&G with BDO in 2014. Now, today he is the principal of Winding River Consulting, a business advisory service company. Gary is a highly sought after speaker, facilitator, and consultant. In his inaugural list of managing partner elite in accounting in 2012, he was identified as one of the only top 10 people recognized as having the qualities necessary and required to be a person in a firm's leadership role. So Gary, welcome to the show.
Yeah, thanks, Roger. It's a pleasure being here.
Yeah, this is going to be an honor simply because I know your story, and I'd like to actually start with that to give some context. First of all, what drew you to the accounting profession? Let's go back that far and just say, why become an accountant?
Because I couldn't become a doctor, so I ended up being an accountant. How's that?
Why couldn't you become a doctor?
Well, I actually have an undergraduate degree in biology from Tulane University, and my first, venture out was to try and go to medical school. It was a tough time to get in medical school. Vietnam War, people trying to get out of the way and things like that. So I did well in school. I applied to medical school. I went through my first round of interviews, didn't get in, went back to Cleveland, Ohio. I got a job working in a research lab at a hospital that worked on dogs. And after working there for 7 or 8 or 9 months, I said, what am I doing here? This is terrible. I don't want to do this. So I got very lucky, and my first track didn't work out. My father had been a CPA, had a small practice. I was curious. So when I was in college, I took a couple of accounting courses, and I liked them.
Okay.
And when I decided that this wasn't going to work for me, I said, okay, let's try something different. So I went back to Ohio State with a biology degree, which means I had to spend a lot of time there in order to get caught up. I ended up with a master's of accounting and ended up working. My first job was for Touche-Ross in 1978 as an auditor in their Atlanta office.
Now, I'm kind of curious then. Obviously, you're in the accounting profession. What caused you to go work for your father? I mean, some people enjoy working in the family business. Others try to avoid it. What brought you into the company itself to begin with?
Yeah, that's a really good question. And you know what? It's been so long ago, I don't think about it often, but it brings back some very interesting memories. So I was working for Touche-Ross, and I decided I had to leave. The reason I had to leave, and I think your listeners will really resonate with this, is that I was really good at what I was doing. I liked it. I was efficient. I had great organizational skills. So I was an auditor, and I rose very quickly to become a senior. And what happened was I started running my own engagements. And what happened was I was so efficient, I was maybe the only person in the history of Touche-Ross who actually got engagements done under budget. And what happened was I got called in to see the managing partner because I didn't have enough charge hours. And it's like, I don't really get this. I mean, you want me to do this as efficiently as possible. I do that. And then you don't tell me I don't have enough charge hours. How does this work?
Yeah.
So I decided that they were way too messed up for me to work for them. And then what was happening is living in Atlanta, we were going back to Cleveland for all of our vacations to visit friends and families. So we finally said, let's go back to Cleveland and take good vacations. So we moved back to Cleveland, and my dad had a little tiny CPA firm, and my father-in-law was also a CPA, and he had one of the largest firms in the region. A firm called at that point in time was Hynix Slavin, which ended up becoming Apple Growth Partners.
Okay.
It was much more like working for a big 8 accounting firm. But my dad was one of these people who was a real principal type people, and I just didn't think he could ever live with the idea that I went to work for my father-in-law as opposed to working for him. So, I made that decision. It was a family decision. It was a decision made out of respect.
Hmm.
And I ended up taking the job with my dad, and it was a total disaster.
Oh, no.
Yeah, it was a total disaster.
So was it the family dynamic that was the hard part, or was there something different?
It was my dad's partner. He
Okay.
was a really good guy. He was a good guy, but he was a guy who had a huge ego, and it's one of these people that is always right, never wrong. And I walked into the CPA firm and I said, "This is no way. I mean, this is it's terrible." So after 9 months, I told myself I got to get out of here. Touche Ross wanted me back because I was such a great auditor, I guess. And then my father-in-law, they would willing to accept me into their organization. So I was going out to a client with my dad's partner, a guy named Ted Saltz. And he was always on the phone, but I caught him in a car. This was before cell phones. And I said,
Yeah.
"Ted, this isn't working. I just don't like it." And Ted's response to me, "Well, I know I'm tough to work with. I don't mean to be that way. I want this to be your firm. I'll stand out of the way. You can do whatever you want to do."
Wow.
And after that drive to the client, what happened was I fired every single person who worked in that office, and other than my dad and his partner, and started building a CPA firm. And 34 years later, we had the 37th largest firm in the country.
It's fascinating. No, you built a wonderful little empire there. And one of the things that fascinates me is not only the growth, but then the sell. So let's talk about the growth for a moment. Clearly, a lot of the listeners are in the process of trying to grow a business, and maybe they don't have the aspirations of being as large as you became. But what insights or advice do you have for us as as you reflect on that growth? What was it that allowed you to become that kind of a business?
Well, from my perspective, it was kind of like looking forward. I had no one to teach me, so I copied a lot. At the end, I found out I was really good at execution, and I always talk about strategies not that hard. So I figured out, where to find strategy. I went to conferences, things like that, and then from there, I was good at executing. And when I look back, we really had three basic strategies we used to grow the organization. And the three strategies are: one was build a larger advisory practice, or build an
Hmm.
advisory practice. When we sold our firm to BDO, we had a more significant and robust advisory practice than BDO had. So we really delved into that. Yeah, am I really smart to do that? No, I just copied what the big eight were doing. I mean, were they CPA firms? Were they financial services firms? Probably more financial services firms. So we attempted to build a model that was more like they had provided their clients, more
Yeah.
services. And for us, it was things like payroll and wealth management and retirement administration. Some of them were separate businesses, some were not. So strategy one was to be more robust in terms of advisory. Started doing this maybe 15 years kind of into it. And that became a huge part of what we did as an organization. And we could talk about that later if you want to, because
Yeah.
there's some real pluses as far as that goes. The second thing we did is we focused on, I became a niche player. And what happened was a friend of mine wrote a book called The Turbocharged Company. I read the book. It focused on 20 companies, 10 public, 10 private, incredibly successful, what made them successful. And one of the things that made them successful in all cases was something called strategic competitive advantage. And what that was really just a niche practice, a niche philosophy. So in 1999, we went from a generalist to focusing on 6 or 7 industry verticals.
Love it.
One of them we got really lucky with, really, really, really lucky, and that was the restaurant space. Had bad vibes. Nobody wanted to go into it. Um, I liked it for other reasons. And we ended up jumping in the restaurant space, and there was just no competition. And at the time we sold to BDO, which was 15 years after that, we had the largest restaurant practice of any CPA firm in the country. And 1 out of every 5 people who were working for us was working on a restaurant client. So it just became such a dominant niche for us. So we started focusing on verticals because I wanted advantage in order to try and get new clients.
Yeah.
And I knew if I had this plethora of large restaurant companies all over the country, we would be more successful. And it was. And because of that, we got better margins, better pricing. We closed more deals, and that played really well. And then the third focus was on geography. And at this point in time, we were in Cleveland, Ohio. There was no firms that had offices in the three major cities in Ohio: Cleveland, Columbus, Cincinnati, other than the big four. And we thought that trying to capture that geography could be very helpful to us. So what we did is we acquired. First, we did a startup in Cincinnati, and then we led to acquiring the ninth largest firm in Columbus, and we had just a huge footprint now in Ohio. And then from there, we branched out a bit. But I'll say today, though, is that that strategy today isn't as relevant today as it was when we did it 20 years ago.
Interesting. Okay.
Yeah, because I just think you can do business. You don't have to be, look how we're talking right now, Roger. I don't even know where you are, but still we're creating this relationship, and we're able to work together. So, and this is how the world works. So it's so much easier to connect to it today than it was in the past. So I don't think geography is nearly as important as it used to be.
Interesting. Good insight. So regarding your growth, was there anything that's as a lesson learned, something that was, I didn't expect this, you were obviously growing quite quickly. What was it that caught you off guard that is something that you could maybe impart here as some wisdom?
Yeah. There's a lot of things that, one of the things I used to find is we were growing so fast, we used to outgrow our infrastructure. And it's kind of like, the wheels started falling off the bus, and, we couldn't do things that were not hard to do because we had just gotten too big for the organization that was supporting us. And oftentimes we had to kind of just stop and take a look at the infrastructure to be sure we had that kind of organization to support things. And that would be like having enough administrative people, having a right technology that's going to be able to service the kind of clients we're at. We just kept growing, and as we grew, we kept breaking things as we moved forward, and we struggled with that a lot in terms of how we move forward. Another thing too is I didn't have anyone coaching me, so I learned a lot by trial and error.
Okay.
So I didn't necessarily have the right skills all the time, and I learned some of these skills as we went along, as we would bump through this thing. So those are the kind of things. We got larger. I know maybe a lot of your viewers today might be smaller firms, and I was a small firm at one point in time. But a lot of it, problems we used to have was me servicing business. In 1999, we were doing about $12 million in business. I had a $4 million book myself, and I was trying to run the firm.
Yeah.
And we ended up making a decision in 1999 that I was going to give up a $4 million book to exclusively run on the organization. And in the next 14 years, we went from 12 to $100 million, 85% organic growth. That would not have happened if I was still servicing a $4 million book of business. So there was lots of things that we had to focus on, but those are the ones that kind of pop out.
No, those are excellent. I love how you address the idea of giving up that $4 million book of business. That'd be tempting to hold on to. So many of the practitioners love the work that they're doing, and to say, I need to transition and fire myself and now move into a role of running the business is intimidating to a lot of them. And so I appreciate you sharing it. Get your free copy of the book In the Black, 9 Principles to Make Your Business Profitable. This is a how-to guide for accounting professionals to work with their clients and actually implement proven processes and systems to ensure that their clients make profit a priority. It is in this book you'll actually learn how to map the business and, in fact, make marketing, accounting, and production a priority within your client's business. You also learn the wisdom pyramid, how to actually take the information you're providing to your clients and effectively use it so that they can make more informed business decisions. This book is designed to help you communicate more effectively with your clients and, in fact, have them see you as their profit and growth expert. Get your free copy now of the ebook today. I do want to move into this mindset now of you've grown the business, you've got this wonderful business. Why sell it? And how did that go about, not only as a decision to sell, but how did you go to market? And more importantly, the transaction of working with BDO to make that actual sale, let's say?
How much time do we have?
Not much, but
Yeah,
go ahead. These are important. I want to hear this.
Not much. It's pretty well known, people who know me. And actually, I have a book that's in its second edition that came out, and I actually talk about the BDO transaction.
Mm-hmm.
I didn't talk about it in the first book. It had just happened. And I finally, when I rewrote the book or updated the book, I actually reflected on it. And I did not want to sell my firm. That was not what I wanted to do. Now, I own 30% of a $100 million firm. So from a financial standpoint, I did really well. But it would never, to me, was about the money. I really liked my firm. I thought we had created an amazing organization. I was really proud of what we had done. In my book, I talk about continuous improvement. A lot from the outside, people would look at our organizations, people who knew us, and they would say, "This is the best accounting firm I've ever seen. This is the best accounting firm in the United States."
Yeah.
We were approached by Ernst & Young, who wanted to buy us and wanted to start building out a mid-market firm, and they wanted us to be the firm to work with in the beginning. So I was really, really proud of what we were doing, and I really, saw no reason not to, go forward. And what happened was, as is happening with a lot in terms of these PE deals today, BDO had reasons to continue to consider buying us. The CEO of BDO was a friend of mine from 1999. He was part of an alliance we were involved with. He sold his firm to BDO. He was with a firm like mine, and I helped with the transaction, so I have a long history with him. He knew we had a stellar reputation. BDO really wanted to grow, and he knew it would be a real PR plus for him if they could acquire someone like us.
Yeah.
So they approached us, and they made us a financial offer that was significant. It was worth more than the firm. We knew that. I knew that, but still didn't want to do it. So what was happening was, in order to sell the firm, it took a supermajority. I owned 30%. I was 3% away from blocking a sale if I wanted to.
Wow.
At my age, I realized that if I blocked the sale, guess what? If anything went wrong in the future, it was my fault. Why didn't we sell the BDO? I blocked the sale.
Yeah.
And at that point in time, I was 61 years old. I only had 4 years to go based upon our agreements. And I really felt uncomfortable in me making a decision for all these younger partners who supported me the entire way along the way to get to where we were. So I suggested, which turned out to be, I don't want to say it was a mistake, but it was really what influenced what happened, is I went to my 33 partners and I said, I think we should do one vote per partner, still with the supermajority. And then what happened was partnership agreed to do that. So it wasn't going to be my responsibility. And then what happened was there was a nucleus of partners who politicized and advocated for the deal for the money. And the firm sold, and I was very surprised. I didn't think it would sell. And then, just a quick story from there. I had a 4-year agreement with BDO. I went over there as a senior partner in charge of growth. It was a terrible fit. Anybody listening to this for the last 15 minutes realizes I'm a pretty entrepreneurial guy. I find myself in the middle of a bureaucracy. No fault to them, more fault to me for understanding what this was all about. And it was a terrible fit. So I ended up leaving short of my 4 years, worked my way out of there. And I love what I do, and I think we're really good at it. And I love to help people. I love to help firms. I got a whole lifetime of doing this, and I wanted to still do it. So I opened this consulting firm. We'll be starting our 9th year, January 1st.
Well, I think that story is something a lot of these people not only can relate to, but maybe are aspiring to experience in some way. Because at the end of the day, we're all looking for an exit, and you've experienced that exit. And unfortunately, you saw this 4-year transition ahead of you, and it wasn't exactly what you're looking for. And I think that's good feedback for a lot of these people, because as we're each looking at how we're going to transition out, it might be as part of the agreement that there's going to be this 6-month, 1 year, 4-year type of commitment that might be involved in the transition that we may not be interested in, because like you pointed out, it was a bad fit. So good insights there. I'm curious, you started this next company, you started obviously doing work, but I know that we wanted to talk about the consulting side of things. You began back in the 90s doing this advisory type work. You do the advisory now. What is it that you feel defines advisory as it relates to accounting services?
Yeah, I look at it differently than a lot of people, and I think there was a lot of misnomers over the last few years. I think people made a lot of mistake and bad investments in it, and for some reason, I think the whole or not the industry, part of the industry thought that being an advisor was or advisory was being a consultant to firms and providing you personally providing different kinds of value to the firm in terms of coaching and things like that. I think that we've always taken this place, especially your viewers, in terms of being the trusted advisor, and I love that role. So I think it's not the trusted advisor role. I think it's beyond that, and to me, it's what advisory is really more of these additional services you can be providing your clients. Smaller companies, certainly payroll is a great fit for that. I had a large payroll company. It wasn't large. It started as a startup. We ended up selling it to CBiz, to a public company. BDO didn't want to buy it, and it just had a hard time sustaining itself without the accounting firm helping it. So we ended up selling that to CBiz. But the way we looked at advisory was what are the other kind of services we could be providing to these clients that could be helpful to them and helpful to our relationship. So we did a lot in terms of wealth management. We did a lot in terms of retirement planning and administration. We did some HR type work for them. So there was different ways we would get involved with that. And it was more of a broader service approach. And then once you look at that, the question is, how do you do that? And I always talk about there's 3 ways to do that. The first way is to build it from scratch, start it, build it from scratch. Everything I ever did in terms of my old firm, SS&G, we built from scratch. We never acquired anybody in terms of advisory. So I built all these firms, or we built them with the people to do it. The second thing you could do is you could buy these firms. Is there somebody you could actually acquire? That's a place that, you start saying, well, firms don't have access to capital. How do you buy these firms? Are expensive. Maybe that's a nod toward private equity and being able to accomplish that. And the third thing you could do, which I try and promote for firms that are smaller, is to share it and find a local payroll company and cut a deal with them and send them all your clients, and in return have them pay you some kind of commission back. Find a wealth management company that has capacity. Work with them, send them your clients, team up with them, earn some money from them. So maybe you won't get the lion's share, but if you're smart and you struck it the same way, you'll get some kind of return. And then the last thing along those lines is what we have found out is the more of these services you provide, you create a much stickier relationship with your client, much stickier. And we didn't force anyone to buy all these services from us, but they liked us. We did a great job. We were service oriented, and it was easier for them, to be able to just work with one vendor instead of multiple vendors.
Yeah.
And certainly didn't require them to work with us, but it was always interesting to me because occasionally we would lose a client, and then we would find out, hey, we're still doing their payroll, we're still doing their retirement administration, and they're still a client, but we're not doing everything we used to do.
Yeah, of course. Well, one of the things I really appreciate you bringing up here is the collaboration. There's a lot to be said about different industries collaborating, such as you've been describing, payroll and the financial services and so forth. There is clearly this client relation that we can facilitate wherein we're actually helping them in various aspects of the business model. So very, very well said. I like what you were saying there. You mentioned private equity. This would be a great place to transition to this. I know this is something that you speak on, and I'm speaking to more and more firms who are getting private equity type solicitations. I'm receiving these quite a bit right now. What are the motivations for a firm to actually consider private equity?
First of all, if you're on the a viewer and you haven't been approached yet, you will be approached because it is moving down market. It is moving down market, and I'll tell you in a few minutes why. I've gotten involved with private equity because I'm not somebody who sources these deals. My deal with BDO to me was not the highlight of my career. And I'm very, very cautious of the fact is I don't want to make money off of somebody to sell them in a situation that doesn't work for them. I don't need the money, and I don't want that on my conscience. So I don't really do that. But I found myself getting involved with this. Number one, private equity thought I could do that for them, which I suppose I could, but it's not high on my list. Yeah. But I started getting involved with the private equities because they're CPA firms. They just happen to be owned by private equity. And what I do is I help CPA firms get better. So we have been approached at Winding River, numerous times, and we are actively working with a handful of these companies today, in terms of helping them build their business going forward. So we have a significant insight into them, and it's been, from my perspective, it's been a huge learning experience. You think you get older and you learned everything, and it's like, it's been amazing, what I've been able to glean from this, and really a combination of my experience against what they're trying to do and potentially how this fits. But this is all derived, well, from a couple things. One of them is maybe a little bit of greed, or maybe a lot of greed, and the second is this whole notion. You were talking a little bit, Roger, ago about an exit. How do you want to exit? And for 100 years, we all exit the same way. We used to sell it to younger people in the organization.
Yeah.
And they pay us out over time, and that's how it worked, and that's how mine was intended to work. And when I bought my dad out, that's how we bought my dad out over time, and we continued it. But the real challenge today is there's just not as many people going into the industry today, or the profession, and there's not as many bodies, and it's hard to find that young person, male or female, who wants to potentially take your practice over. And that even gets more complicated when you talk about these generational differences and what millennials want. Do they really want to own this? And to the Gen Xers, is this really what they want to do? And they want to own this, and maybe not so much, in terms of what our lifestyle was. So this whole element of succession has become very challenging. I think a lot of it is what's been driving this consolidation, pre-PE joining the industry, in terms of firms merging up and getting larger. With the whole notion, well, then, larger firms can, handle all this, and we'll see. I don't know. We don't know yet.
Well, what does a private equity firm actually look for in a bookkeeping, accounting, or tax business, a CPA firm? What's intriguing to them that they're trying to acquire?
Well, they will tell you, and maybe I don't really understand it, totally, but they'll tell you, oh, these are the perfect businesses for us. Why are they the perfect businesses? Because there's cash flow. You're not dealing with things like inventory. You have annuity situations with clients. Do a good job, they come back. So from a business standpoint, it's really not high risk type of business. So they like that nature of the business. Okay, so that's what attracts it to them. But in my mind, what really is attracted to them is that there is thousands of private equities in the United States, and private equities have one role. And their role is to buy businesses at one level, sell it for more, make more money for the investors.
Yeah.
And there's a lot of them, and a lot of them were vying for opportunities. And all of a sudden, because of a transaction 3 or 4 years ago, an entire industry opened up to them. It would be the accounting industry. So they're all over the industry. And, some private equities don't want anything to do with the professional service business, because they don't like the fact that the employees walk out every day, and if they don't come back, you got a problem. But there's, so some of them rule themselves out, but a lot of them are looking at this and saying, yeah, this is really interesting, and, for us to get into, because it's really blue ocean. There's really not a whole lot there. Mm-hmm. So you're seeing this thing really being, really looked over by private equity to see if this makes sense for, their particular strategy.
Very good. Well, I'm working right now with two private equity firms as they're acquiring accounting firms and training up the staff. And so I'm familiar with this at a distance. But one of the things that I'd be curious to know is, how does the deal generally work? I mean, what should we as an accounting professional know as we're approached by these private equity firms as to what the transaction might look like?
Okay, so let's start off by talking about the fact that there's really three types of different approaches from private equity.
Okay.
And one of them is, at this point, is not going to impact most of your viewers. And what that is a platform private equity. So that is Cherry Beckert, that is Citron Cooperman, that is Eisner, that is Baker Tilly, that is Grant Thornton. And what's happened is they are acquiring these firms, okay, what they are doing is they're using these firms for the platform, and the one thing that they want to do is they want to grow revenues, and by growing revenues, there's this I don't know what the word would be, but there's this idea that the larger you get, you are more valuable, and there's a greater multiple times your call it your free cash flow.
Correct. Yeah, you can get a greater multiple the larger you are. If
Right.
you're a 1 million firm versus a 5 million versus a 10 million, you're going to see your multiples going up simply because of the size. So yeah.
So that's exactly what they're trying to do.
Yeah.
Now, everybody on you're on this this session here knows that value is pretty much adjusted EBITDA times the multiplier. So do they want to adjust EBITDA? Yeah, of course they want to adjust EBITDA. But anybody who's been running an accounting firm, and especially as long as I have, knows it's really hard to adjust EBITDA, to try and get an extra 1 or 2 or 3 points. It's hard to do that. Okay, it is not easy to do it because most of our costs are labor costs. There's ways to do it, but it's going to be minimal, as you move forward. If you grow a firm and you could take a multiple from 10 to 12 in a short period of time, you're going to get a nice return. So a lot of their focus is to get bigger, to increase the multiple number going forward. And then in these large platform ones, it's even more than that, because what they're going to do is they're going to try and acquire smaller firms than them at a multiple at less than what they got purchased at. So if they got purchased at a 10 times cash flow, they might be able to buy somebody at a 7. So from a 7 to a 10, you make money, but from a 7 to a 12, you make more money.
Yeah.
So these firms are really focusing on one thing only, and what that is just to try and grow their size. The larger they get, the larger the multiple gets. That's their main their main function. Now with Grant Thornton, I'm not so sure. I think Grant Thornton is large enough to potentially do an IPO, and they may be able to create an exit through an IPO. Okay. They're not going to do it in a $400, $500 million firm. It's just too expensive to do it. I'm not sure the market is there. So that's one way. The second way is a roll-up. And at this point is probably going to maybe impact your viewers more. And what a roll-up is this is a roll-up of smaller firms that are not in the $100 million ranges, but are in the $10 and $20 million range. And there's a group of private equities that are trying to put a group of these firms together. Now, when they put them together, they're really focusing on 2 things. One is size, to increase the multiple. But there is a chance to try and increase your EBITDA, your cash flow with these smaller firms. Because if you go put together 5 smaller firms, now maybe you can go buy a firm in the Philippines as your outsourcer. And maybe there's some advantages of that. And maybe there's some synergies that could be created by putting 5 $20 million firms together. We only need 1 marketing department. We only need 1 CFO. So there's potentially some ways to try and increase EBITDA in those organizations. Challenging part of those organizations is you have 5 organizations and you're trying to put them together and make it work. A lot different than taking something like an Eisner, which is already a $500 million firm, and adding a $30 million firm. Totally different dynamics in terms of doing that. So there's a bunch of firms trying to do this. And then I want to come back to this in a second. Let me give you the third element. And the third element is you're seeing some private equities focusing on doing minority investments. Everything I just told you before is a majority investment. So the CPA firm is selling the majority, usually somewhere between 70 to 85% of the firm to this private equity. And you have to have this alternative structure because non-CPAs can't do audits, so you have to have an alternative structure, which was really developed by CBIZ 30 years ago. And I guess it's a valid way to do things. But what a minority investor is doing is they're going to a firm and they're saying, a young firm that wants to continue going and not sell down the road. And they're saying, would you want to have the lion's share of the growth? And I'll provide you the capital to do it in a minority situation. And in the last 3 months, there's been 3 minority deals. One has been done by Sickage, where Bain Capital invested $250 million. The second one was with Armanino out of California. And the third one was Cohen & Company out of Cleveland. And they all took minority investments, okay? So they took significant minority capital to try and grow the firm going forward. Now, even though it's a minority, what happens is those minorities have majority rights because they could come back to the firm and say, I want my money. And the firm's going to say, well, how am I going to raise this money, which may force them to sell the practice. So they have some real strong ability to move it forward. But, where does this all come? And this is what I wanted to come back for. And this is where your audience is. I think they're going to start seeing a lot more activity in smaller firms, assuming we're talking to firms that are a lot of firms that are $5 million and less. They really haven't been a part of the game, okay? But what's happening is everybody wants to grow, okay? And we're kind of running out of firms to buy. And my practice, for the most part, represents firms that want to stay independent. And these are great firms. I'm respectful of all of them. They're all accomplished firms. They don't want to sell. So you're a firm that has a minority investment or a majority investment. You want to continue buying firms. Where are you going to find these firms to buy?
Yep.
And I think what you're going to see is a significant and probably the majority of the market, okay, are your viewers. Now they're smaller. They're $1 and $2 and $1 million firms, but there happens to be 35,000 of them. And there's a tremendous amount of firms. So I think you're going to see some of this consolidation starting to move down market.
That's what I'm actually starting to see. So I would agree with that.
Yeah, because of the need. But it's challenging, okay, because of the fact, instead of trying to consolidate 5 $20 million firms, now you're going to try and consolidate $52 million firms. And it just there's a lot to that in terms of that integration.
Yeah, but I am witnessing this. I'm seeing where firms that are of that smaller size being acquired, and I do feel it's in line with what you're describing. If you're looking to advance your career in accounting, you need to enroll now in the Job Placement Assistance Program. This course is created for accounting professionals to find a new job, apply for a promotion, or get a better position within a company. It is a turnkey process to actually help you better interview, get the job you deserve, and get paid what you're worth. For more information on how you can take advantage of this offer, go to the episode description. Enroll now in the Job Placement Assistance Program. Do it for free and act now. So I do want to ask, what are the risks? As you're a business owner and you're being approached by a private equity firm, what are the risks? And obviously there's a flip side. What are the rewards? But let's start with the risks.
Well, if you're a senior partner and you're looking to get out, you just got a gift from the heavens.
Yeah.
Okay. You don't have someone to buy you out. Okay. You don't know what you're going to do. And all of a sudden, Mr. or Mrs. Private Equity shows up. And what they want to do is they want to buy your practice and they want to give you cash now for your practice. And, if you're old enough and this is what you want, this may be a fabulous exit strategy for you. And your risk is absolutely zero. You're getting your money, you're out of there. Now, in the olden days, or if you take the other route and you want your younger partners to buy you out, you have risks of, can they run the firm? They're probably not going to personally guarantee what they owe you. Could they pay you out over the next 10 years? So what you do is you mitigate all risk if you're a senior partner, okay? And that's where I was mentioning in the beginning, is there greed involved? I mean, the way I'm looking at this thing is most of these larger firms that are doing deals, the average partner is getting $2 million, $2.5 million for their. Now, it's a lot of money, but it's not a lot of money. But if you have a good practice, you're making $400,000 or $500,000 a year, you're not rich, you're comfortable. And, $2 million is probably enough money to pay off your mortgage, to pay for your kids who went to college, and it could be life-changing. So you're seeing a lot of interest from that standpoint on the greed side. Now, to me, the big question becomes is, what if you're the 35-year-old partner? Your deferred compensation or your buyout is gone, okay? And what they're doing is, remember, I told you they only buy, they don't buy the entire practice. They buy 85% of it, 70% of it. Yeah. That 15 to 30% is given to the younger partners. So the younger partners have an equity stake going forward, okay? And the way they would make money is when the private equity decides to sell the firm to somebody else, they could have an event.
Yeah.
But, okay, one of the buts is, in almost all cases, they're not allowed to sell all of their stock. They only could sell 40 to 50% of their stock. Why? Because if they're going to sell it to somebody else, they don't want these people going to the beach. They need them to continue working. So they could maybe give them a partial liquidation, but certainly not enough of liquidation going forward. So, and then now you're a younger partner. You have no say-so in how the firm's going to run, okay? It's owned by private equity. They make all the decisions, okay, at some point in time. All of a sudden, you may find out you're sold. The new person who bought you, you may not like them, you may love them. You don't know what's going to happen. So there's a lot of risk in terms of what a transaction would look like. So I think a lot of the risk certainly is going to go down to the younger partners who want to stay in the organization. The older partners are, they couldn't be happier. And I think, I hate to say it, And a lot of people tell me I'm wrong and all that, but you know, that's a lot of money for these people. And you're seeing one after another take these dollars, and it's going, predominantly, or a lot of it's going to the senior partners as opposed to having a traditional buyout. They're getting a gift from the heavens, a very different buyout for them.
What kind of timeline does it take for one of these transactions to happen? If you're solicited and you entertain it and you begin the conversation, what kind of timeline are we looking at?
3 months.
Very good.
They're smart. They got their lawyers. Not your lawyers. They probably already have deals. 2 to 3 months. At the beginning, these firms were talking about trying to find the right firm and things like that. There's so many firms that are gone, and there's been so much consolidation. It's almost like a land grab right now. There's almost so much land, so I think their bar is lowering because they want to, they don't really care. They'll rather buy the firm and then try and move it forward. But the one thing I think people have to realize is that, and I think it's really important to realize, these private equities are not doing this because they want to be nice to us. Okay. They're doing it for one reason and one reason only. And they will tell you that and be clear about that. What they want to do is they are buying your firm to sell it within 2 to 3 or 4 years to try and make a significant amount of money off of it.
Yeah. Yeah. So I've got a question regarding if one of my listeners is wanting to pursue one of these things, how do you reach out and rather than being solicited, how do you reach out and approach a private equity firm? And more importantly, how do you distinguish between the solicitations, which one to perhaps go with? Is there any advice that you have as to how to select which one's going to be the best fit for you?
When you do a deal, there's, people, when you look at deals, and I've been involved with tons of deals, most of the diligence that happens on the deals happens from the top down, not from the bottom up. Okay. And I think firms that are considering this have to do their level of diligence from the bottom up. Okay. So they need to know, what their plan is. Okay. Unfortunately, what happens is, once you sell, you lose control. So they can change the plan. They're not going to, agree to the plan. But what kind of firms are they buying? What have they done in the past? A good one to mention is, I do a lot of work with a group called Ascend. Maybe some of your listeners know of that one. They're part of a group called Alliant Capital. The guy who's running this thing, he's great. I really like him a lot. We've become friends. He spent a lot of time with me trying to understand the industry, and he has a track record in another industry that's a pretty successful track record. It was in the dental industry, in terms of the human nature of what they're doing, just not the financial nature. So things like that to me would be, of importance. What have they done in the past? What kind of firms they're buying? How long do they want to hold these things? If it's a roll up, they're not going to be able to sell it as quickly. So maybe that's a 5 or 6 or 7 years. What is their strategy for the younger partners? So I think you just got to ask a lot of questions if you really care. But if you don't care, and this is just an exit for you, take the money and run, because you're going to get more money from them than you will anybody else.
Good. No, this is great information. The next thing I want to ask is, I'm going to ask it from a personal side, meaning your personal side, which is you've talked a lot about the money and there's good money to be made, but you've experienced this. It's not always about the money, which is to say, once you've sold the business, the grass isn't necessarily greener on the other side. When you're an entrepreneur and you're driven, you've got a lot of ambition, and then all of a sudden this thing that you've created is no longer yours. You wake up in the morning at some point and realize, I don't know what I'm supposed to do today, and you have to reinvent yourself. Can you speak to a moment about what that's like after you grow an empire, build a business, sell it, and you have a great exit, but at the end of the day, months later, you might have this reflective moment of, crap, I don't know who the heck I am.
Yeah, I mean, Roger, you just talked about my whole life the last 10 years. That's really kind of, what it was for me. But, if this is an exit and you truly don't have a way out, and this is an exit for you, do you really care, as much? I don't know. Maybe you don't care. Maybe you care about your people. Maybe you care about your clients. Maybe you only want the money. So if you only want the money, then, you don't care. If you care about your people who got you there, you care about your clients who got you there, then you just have to open your eyes and realize, that, how is this going to impact, what I've created. And in my case, I didn't want to sell. I loved what I did. I could easily say that when we sold, from a financial standpoint, BDO did exactly what they said they were going to do. They paid every penny they would. There was no issues there. They were totally upfront with it. But I found myself still wanting to work in an environment that just wasn't where I wanted to be. And what that forced me to do was that forced me at 63 years old to start a business. Who does that at 63 years old? Some people do, but not a lot. Okay. And I just wanted to continue doing it. And, I love what we've created at Winding River. I'm so proud of it. We've done such amazing work for so many firms. We have so many loyal people. We do a lot of leadership development training. I have this program called Managing Partner Boot Camp. I train people to be managing partners. I have had 200 people go through my course. Of the top 500 firms in the United States, I'd say 1/3 of the managing partners I've had the opportunity and the privilege to work with and help them be better. I mean, running a good CPA firm was fun and I loved it and I love my firm. I think I'm providing so much more benefit to the profession personally that it's gratifying to me. So, I got a lemonade out of maybe a lemon back then, but it could happen.
Yeah, no, what you're sharing there is, I think, very impactful, not only for you. Clearly, you're doing a great job, and it's obvious that you love what you're doing. But at the same time, I think it gives hope to everyone listening to realize there is perhaps another chapter that they can actually embrace at that point where they sell and then find themselves doing something different. So I like that. I do want to ask about the timeline of this. I know that you and I kind of had this conversation a long time ago, so I don't know if you recall, but with private equity, yeah, there's a demand and they're gobbling up the businesses, and rightfully so, there's an exit here. How long do you see this lasting in the sense of, if I'm being solicited, I might say, well, I'll just hold out and I'll do it next year, or I'll hold out and do it in 2 years. But in 2 years, I might not be solicited and the private equities may not be interested any longer. What kind of timeline, what kind of roadmap do we have here?
Yeah, you're asking a really good question. I'm working with a firm right now that I love, and they are doing just knocking it out of the park, and they're not sure what their exit is, and they say, yeah, I'd love to exit through private equity because we're doing so well, but we don't want to do it now. We want to do it in 5 years. And I'm like saying, boy, I don't know if the window's going to still be open in 5 years.
Mhm.
I just don't know that. But you know what I tell people? I consistently tell people this. Even if you're trying to position yourself to potentially sell, and you don't want to do it now, you want to get cleaned up and have more earnings and those kind of stuff. There's nothing wrong with building the best business you could build, regardless if you sell it or not. You're not going to be unhappy with it. So, from my perspective, just continue building and doing it right, and making the right kind of decisions, and options will be there. Do I think this is going to go away? I don't think it's going to go away for a while. I think it's here for years to stay. I don't know how many. It's going to be very interesting to see what happens when these firms want to exit, and how they're exiting, and how they're treating the people that are left. Another whole chapter that I've been doing a lot of talking with people about too, that I'm very intrigued with, is anecdotally, I talk to firms all the time, and anecdotally, I'm talking to firms that are saying, hey, we're getting new clients left and right, and people leaving these private equities because they don't like what's there. They don't like the setup. They don't like the situation. Now, I have no numbers. I have no statistics on it. I only have these anecdotal stories. A guy, boot camp alumni, has got a young partner. I talked to him the other day. He said he was with one of the 3 platform firms. He was an office of 12 people, 12 partners. 8 of the partners have left. So I don't know what's happening, and how that is going to be communicated or maybe interpreted from the rest of the profession going forward, if this maybe doesn't work or not. So that could be a factor as we go forward too. Is are some of these things starting to unwind? And certainly, if you made these huge investments in these firms, you're not going to tell anybody that. You want to keep that. You don't want anyone to know that things aren't going that way. But we've all been along. Anything too good, you got to really is not too good. So you just got to have to be very, very, careful and understanding, what you're really getting involved with.
Yeah, no, I'm loving your words of wisdom here. I appreciate it. Your insights are very, very, very spot on, and more importantly, applicable to what we're talking about with the accounting firms today. So very, very good. I do want to ask a question regarding you. How has your life changed with not only the sale to BDO, but now starting your new advisory company where you're servicing the accounting professionals as they become partners? How's this benefited you personally? How's this affected your family?
Um, so, no secret, I didn't want to sell. I had the best accounting firm. I love what I was doing. I went to BDO with open eyes, um, and I was hopeful that this would be the great next chapter for me. And when I went to BDO, I was clearly the only person who was in BDO's offices who took a startup to $100 million. So I had a different skill set than anybody there. Now they were operating a larger firm, but they had a different skill set. My skill set didn't fit. Okay, it just didn't fit. Way too entrepreneurial, and it didn't fit. So I found myself in this position that I was really probably maybe the toughest spot in my life, other than when I didn't get to medical school 40 some years ago, or almost 50 at this point. So it was really difficult for me. And and I wanted to start this consulting firm. I had played around in this. I used to have a conference I owned with Alan Colton and Gary Boomer called Winning is Everything. We had that for 20 years. And, and I'd done some consulting thing, and I thought that I could be helpful. And my biggest fear was I didn't want to be going back and forth in airplanes all over the country. I was too old to do that. I just didn't want to do that. When it runs perfectly, no big deal. But when you're stuck in, Dallas for the night at the airport, it's like, why am I doing this? So I was really scared to do this. Two things happened to me. One is I was finishing my book, Building Blocks, and I had a ghostwriter, a woman named Marcia Least. And as I was writing the book, Marcia said, you know more about running a CPA firm than anybody I've ever met before. Did you ever think about teaching that to people? And I hadn't. And that's what gave me that planted the seed to build this program called Managing Partner Bootcamp. And we have a second program now called Basic Training Bootcamp. So that was one thing that happened. And the other thing that happened was the pandemic. And the pandemic helped me, to the same extent as anything, major in my life, because it allowed me to do consulting for firms all over the country, like I'm talking to you right now, Roger. I didn't have to get in a plane. And when we created the boot camp, what was so great about the boot camp is we just had 39 firms in Chicago 2 weeks ago, either through Managing Partner Boot Camp or Basic Training Boot Camp. In the olden days, that was 39 plane trips.
Yeah.
Today, it was one plane trip to Chicago. They come to see us. So I got very fortunate in building a business that really was able to deliver what I wanted to deliver, but at the same time, was able to meet the needs that I want to do personally. So that's worked out really well for me. I'm a juggler. I own restaurants. I have conferences. I'm very involved philanthropically. I've started a couple not-for-profits. I like to juggle stuff. And this fits great with me. I'm moving my office to Florida in 2 weeks. I'll be there for 4 months. I have our team here. So I'm a lucky guy. I'm a lucky guy because I'm doing something I really like.
You're living the dream.
Yeah, I am.
There you go.
Lucky.
Well, Gary, it's been a pleasure. It absolutely has. So here's what I'm going to do. I'm going to wrap this up, and I'm going to come back to you for a closing thought. Before I begin wrapping it up, there are a few things that I'd like to share with our listeners. There are 2 offers that I'd like you to take advantage of. In the episode description, there are 2 books. One is called Your Strategic Accountant. It speaks to essentially what it is to build the premier accounting firm, offering the services that your clients need, and most importantly, doing what you can in order to affect the growth of your business. The second thing that I'd like to point out is a book called Your Profit and Growth Expert. It gets into this advisory discussion, some of what we've discussed today. What does that advisory role look like, and what is it that you can be doing for your clients from the perspective that you have as an accounting professional? So get these 2 books. Each is free. One is called Your Strategic Accountant, the other Your Profit and Growth Expert, and take advantage of those offers today from Universal Accounting Center. The second thing I'd like to do is just kind of summarize the phone call. One, I love the beginning, just finding out from Gary that this didn't start with with the intention of, with his father being an accounting professional, his father-in-law as well, that's clearly the path I'm going to take. He obviously began with the medical expectations, and when that was thwarted, he did find himself gravitating towards accounting, and clearly that was a great choice. He's done phenomenally well. He found himself in a situation of working in a family business, eventually taking that over and growing it to one of the largest accounting firms in the United States, that of over 100 million in revenue and 600 employees. And it's definitely something that is well deserved because of three things that he shared. Strategy. He had a strategic approach to growing the business, and he was really bullish about what he did. He stepped forward without coaching and actually took the bull by the horns and did what he needed to grow the business strategically. But he identified two additional things that he felt that were instrumental to the growth of the business, and that was niching his services, finding a handful of niches that he could identify, go deep in, and really specialize, one of which was restaurants. I love the fact that he was able to say that this was a poorly developed market or industry that he could actually own, and he did so, becoming very much the prominent accounting firm, CPA firm servicing the restaurant industry nationally. The next thing was geography. He found that geography was something that he needed to have, and so getting a footprint in a specific area was something that was intentional. He did indicate that he doesn't feel that that's so necessary or prominent today because of the remote work that we're able to do. And I clearly understand that, but do feel that there is still some value in having a geographic presence and owning the marketplace in which you're in. So those were three great pieces of advice. The other thing that I really enjoyed was just the conversation about selling the business. Clearly, he had the dynamics of selling the firm. He had those 33 votes that needed to take place, didn't believe it would happen. And even with a 30% equity share in the business and a financial win, it wasn't what he ultimately wanted. And he recognized that with the transaction, it wasn't going to be the best thing. He went into a new employment relationship begrudgingly and found that it didn't work out. And I completely understand that. With the entrepreneurial spirit and drive, it is sometimes hard to find yourself in a W-2 role. And that being the case, he was able to back out of that early. But in doing so, he has now created a wonderful organization that services CPA firms, helping individuals on that pathway to partnership so that they can, in fact, grow their firms and do so with some direction from Gary and his team. And I think what he's accomplished today and what he's doing for the accounting community is very much deserved and helpful. So thank you for that. The other thing I'd like to just end with is the fact that with regards to private equity, we had a great conversation about what that looks like, that there are solicitations going on and why they are happening, that there are really three strategic things happening here. One of the things is the roll-up that we're seeing with the smaller businesses. Clearly, we need to understand that they're coming in with the intent of getting a larger share or ownership of the business with the intent of at some point selling the company. They're giving the younger employees the option of having some equity in the business so as to retain them. Wonderful insights as it relates to the business. Clearly, there's some money to be made, and I think for the next few years, it's something that we're going to be witnessing around us and perhaps being, as owners, offered to us. And so we need to be prepared to evaluate whether or not this is the right time for us and what that exit might look like. So lots of valuable insights. Gary, you were very kind and forthcoming, and I appreciate that. So do you have a last words of advice for us?
Can I have more than a couple of words?
Please.
Okay. I wrote an article recently. It was in Accounting Today. And I think this article, it really relates to your viewers. And I talk about the trusted advisor, and I talk about the profession is changing, and a significant amount of the profession has become transactional versus relationship. And I know the people listening on to this podcast, I know you're relationship oriented. When I built my firm, we were relationship oriented, the trusted advisor. We were there for our clients. What's happening is these firms get larger and larger and larger. They become much more transactional. Get a tax return done, do something, a project. But a lot of times what they do is they forget about the relationship between the clients and the professional and how valuable that can be. And what we're seeing is in the way the profession is going is that that in my mind, in terms of what you're doing for your clients, is of premium value. It is premium. It is worth a lot. Okay, and I am trying to get firms to realize that what you're offering is premium. It's not transactional, and you should be charging for that. And there's not enough people doing what you're doing. So you get the supply and demand, which means that you should feel pretty good about charging a premium product or premium pricing for a premium product. because it is really worth it. So, if you want, find that article. It's in Accounting Today. It was maybe 2 months ago, but I talk a lot about that. And I think that's really has strongly resonates with smaller CPA firms.
No, appreciate that. That is wonderful. And I do agree. This is a person's business. As much as we love the numbers, at the end of the day, it's relationship based. And I appreciate that ending there. Here's what I'd like to do to kind of tie everything up here as we end the show. First of all, for my listeners, if you haven't already subscribed, definitely subscribe to the podcast. Love to have you actually notified each and every week when we release a new episode for you to actually hear from the experts, those individuals that are helping us identify those things that we need to be working on as we're building the premier accounting firms in our area. The second thing I'd like to invite you to do is, if you haven't already, register for GrowCon. GrowCon is an annual conference. It's an event where we actually bring to the stage those experts that need to share with us those things that we need to consider as we're running our business, whether it's marketing, growing the business, selling, pricing, perhaps it's client relations, what we can be doing to increase those, retain the clients longer. Maybe it's mental health. It's those things that we need to consider as we're running our business. Perhaps it's exit strategies and what we can be doing to prepare for our leaving the business. There are a variety of things that you need to come and learn and understand as it relates to running your company. But likewise, meet the peers, those individuals that are in attendance who are like you, running the businesses around the country and around the world, who come and join us. Why? Because these peers are individuals that you can relate with, build friendships with, network with, but at the same time, collaborate. There are various things that you might actually find that can assist your clients as you're finding different resources that are available to you at the conference with the peers that are in attendance. The next thing is universal. You can meet the team, the staff, myself, those individuals who are committed to helping you be in business for yourself, but not by yourself with Universal. So join us for GrowCon. Love to have you there. Register now and get your ticket, and we'll see you in May. The next thing I'd like to actually do is, with regards to this show, if you would like to discuss these things or learn more, first of all, go to universalaccounting.com, and in the navigation of the website, you'll find podcasts, and there we've accumulated highlights. These highlights are playlists that are basically there for you to binge listen, those various things that are applicable to your current situation. Hear from the experts, the things related to marketing, selling, pricing, tech stacks, and so much more. Go there, binge listen, and get those insights that you need today. Lastly, with regards to these concepts and principles that we've been discussing, if you'd like to know more about these things, feel free to reach out to us here at Universal Accounting Center. You can do so by going to universalaccountingschool.com or calling us at 801-265-3777. And always remember this, if it's about accounting, it is universal. Take care, have a great day, and be safe out there.